Good afternoon, Quasar Markets Live. I've got my friend Michael Litt. Michael from the Big Short fame, Mr. Front Porch himself. How are you, bro?
Doing well.
You know, last time you and I talked, we talked about a lot of things, including the bond market. And you're going to give us an update today, a quick one here. I love this. And I'm going to get out of your hair. So, Michael, give us your thoughts on what the bond market is. And, of course, we talked about it earlier today, valuations. I'm going to get out of your hair. Have fun.
Good. Well, actually, you and I were down on the floor of the New York Stock Exchange, Stephen. It was just before Christmas. And I was talking to you about the Japanese yen carry trade and to watch that. And we'll touch on that a little bit today. But I think the consensus was that interest rates were going to come down and that we were going to see sub 4% 10-year rates and lower mortgage rates. Mortgage spreads have actually tightened a little bit, and we saw mortgage rates coming in under 6% or just above 6%. But the 10-year bounced off 430 the other day. And that was not in expectations when we talked. We also had a hiccup coming out of Japan because of something the prime minister did in terms of his policy mix. And that set the markets back a little bit. So that risk is out there. So we'll touch on that a little bit. The market, the S&P trades at 22 times earnings right now. It's had a range over the last 5-6 years of 18 to 22 times. And the one aberration was when in 22, when the interest rate hikes were in full swing, we saw the market trade at 16 times earnings. So we're at the high end of the range in terms of valuation for the market. And I think a lot of people have been struggling lately is, where are we? Are we playing offense or defense? Are we at one end of the field or the other? We're definitely at the high end of the field in terms of valuation. Interestingly, since Liberation Day, which was April, whatever that was, 3rd, 10 months, 10, 11, let's see, 1, 2, yeah, but 10 and a half months, so 11 months ago, it has paid to invest in companies that have no earnings within the S&P 500. In fact, companies with no earnings have outperformed companies with earnings by 20%. And they've really driven the performance of the market. It's a lot of your beloved tech names, Stephen, and other companies that have negative earnings. Expectations for earnings this year are robust. They're looking for earnings to go from the current estimate. We'll see what the final total is for 25 when we get all the numbers in, but 272 is a decent fix for 25. 26 consensus expectations are 306. That's a 12.5% year over year growth rate. Now, that's well above the 8% average, but there are some reasons to believe that you might be above average because you've got big fiscal stimulus this year. I mean, the OBBBA kicks in. It's a big fiscal stimulus package. Now, it comes at the expense of a very large deficit. If the Supreme Court finds the tariffs to have been outside of the authorization of the president, then you could be pushing from a $2.5 trillion to a $3 trillion deficit number in 2026. But it's we're borrowing money and stimulating the economy. Make no bones about it. Stephen, I think your volume is off. You're muted.
Yeah, we heard it from Kathy Woods last week that she's saying growth of 7%. The IMF now says U.S. growth of over 4%. Trump's saying even more than that this year. What is the basis of that talk?
Two things. This massive fiscal stimulus from OBBBA, mostly, as we've articulated, the top 10% of households are getting huge amounts of tax reductions, and the top 0.5% gets half of that. So, and the tariffs get paid by everybody. So the lower 9 deciles of income don't get the tax break and pay the tariffs, right? I think the 80th to 90th percentile just about break even. They actually do a little better on the tax pay the tariffs and they're net flat, but the top decile does well, and the top 0.5% do get half of all this stimulus.
Yeah, and Larry Fink and BlackRock and Davos this yesterday said that we're not an AI bubble. Are you implementing AI data, AI money, AI investment, AI data warehouses? Are you putting that into your thought process?
Well, AI, I'll tell you this: borrowing spreads for AI hyperscalers, right,
Mm-hmm.
have tightened slightly,
Mm.
where industrial companies are paying quite a bit more on a spread. Not only are they paying the 10-year at 430, they're paying close to 100 basis points in spread.
Yeah.
So your traditional industrial companies are paying a lot of money. Lenders are very willing to lend money to hyperscalers, Stephen, at 30 to 40 basis points less than industrial companies, who have seen an increase in cost of funds. Interestingly, now the fiscal stimulus is huge. There's no question about it. This is a massive increase in the deficit and a big fiscal stimulus package. Period. It's old school. In a way, it's old school Democratic fiscal policy, right? I mean,
socialism wrapped up in the pig.
We might as well have a Democratic president looking at it through just that narrow lens, right?
Yes, right.
It's pure deficit spending. Now, the yield curve has steepened, which nobody expected when you and I are at the New York Stock Exchange.
Right.
People were still telling me interest rates are going down, mortgage rates are coming down, da 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 da. And I said, let's see. I think the yield curve is going to steepen. Well, a steep yield curve encourages banks to lend, Stephen.
Yep.
Because their interest rate margins increase. So there's a second stimulus. You're going to have lenders coming to the table with a 430 10-year and, a much lower short-term rate and the potential for even lower short-term.
Yeah, and I'm looking at the 10-year. That's just the contango now, but you're pushing it now in the 10-year now to 2055. So roughly 24 years from now at 4.863. So it's not much contango there, right?
That was that far out. Something could change, especially with the Federal Reserve's identity in question. I think a lot of the attacks on Powell now are, which is kind of silly because he's out of the office in 90 days, right?
Right.
The FOMC meeting in June will be chaired by whoever he appoints, whether it's Warsh or Reeder from BlackRock or Waller. Waller wants it so bad. He's probably the biggest sycophant of the bunch. But no matter who, I've been looking at what's this guy's characteristics, what that guy I'm like, screw it. He's going to steamroll them all anyway.
Right.
It's a puppet Fed. We've talked about the risk of the puppet Fed in the long term, going back to Arthur Burns in the 1970s and the issues that created for Volcker to have to tamp down inflation and a dollar that fell to half its value against the German Deutschmark at the time, which was kind of like the euro. But one of the things I was thinking about, the sort of the medium and long term projections of a puppet Fed. What this Japanese carry trade kind of hiccup the other day, and the backup in rates, which seems to be holding, is that you have to realize people in the equity markets have to understand that the bond market provides liquidity, the liquidity backdrop.
That's right. Okay?
When the great financial crisis was a bond-related issue, the liquidity went away, the stock market got crushed. Stocks with no earnings got crushed 2x.
Even more, right?
Yeah, 3x. So people are saying to me, how much risk is there? They always ask me, is the market going to crash? And I'm always like, wait, what do you think I am? Like a freaking,
I don't know, man. You got a pretty good crystal ball there, Michael.
I will tell you that the liquidity backdrop is why you get the luxury of trading at 22 times and get 20% outperformance for companies with no earnings. That kind of risk taking is fine when you have a lot of liquidity. a big liquidity pump, not the most important liquidity pump, but a big liquidity pump is the Japanese carry trade that you finance in yen and then you buy US dollar assets. When that reverses, you can see just the little tremor we saw the other day, you can see what happens.
Yeah.
If this sort of puppet fed in the near term, what I'm realizing is that's going to make things like the liquidity provision by the Japanese carry trade more vulnerable. And and I saw this in the RISE risk system, which is the one risk system that runs true nonlinear risk. And I've told you about this. It is seeing an increase in the nonlinearity relationship between the Japanese yield curve and the US yield curve. If you're financing in a yield curve and investing in another yield curve that become wholly unrelated, you're taking way more risk in putting that trade on than you were previously.
Right.
And it has a higher probability of going against you, meaning you're going to wake up and have a Texas hedge, right?
Texas hedge, I'll leave it at that. I love it. And we're not going to explain it today. Look at what Texas hedge is. You'll totally get it. Michael Litt, we'll see you right back here next week.
All right, buddy.